now let's talk about vacation pay, which is still part of employees' expenses. The liability to pay for employee vacations could be accrued as a liability at the end of each pay period. However, many companies wait and record an adjusting entry for accrued vacation at the end of the year. What companies are supposed to be doing is that at the end of the period, let's say they pay their employees bi-weekly, they have to record this vacation pay every other week. If they pay monthly, then at the end of the month they should record the vacation pay or do an adjusting entry for that. However, most companies, they wait until the end of the year and they record this kind of vacation pay. So let's see an example. Assume that employees earn 1 day of vacation for each month worked. The estimated vacation pay for the year ending December 31st is $325,000. The adjusting entry for the accrued vacation would be simply as follows. We debit vacation pay expense and we credit vacation pay payable. So you can see here we use the same value that was given to us and we simply record the expense at the end of the year and we create this liability, which is called the vacation pay payable on the credit side. So once the employees start taking vacation, we're going to use this liability that we already created. So if employees are required to take all their vacation time within 1 year, the vacation pay payable is reported as a current liability on the balance sheet. If employees are allowed to accumulate their vacation pay, the estimated vacation pay payable that will not be taken within a year is reported as a long-term liability. And again, most companies, they require their employees to take it within 1 year for simplicity reasons so they can record it under current liabilities. But if they have a policy that allows them to extend or allow them to use this vacation pay in a future year, then in this case, this can be recorded under long-term liability. So when employees take vacation, the liability for vacation pay is decreased by debiting vacation pay payable, salaries or wages payable, and the other related payroll account for taxes and withholdings are credited. So we reduce the liability by debiting the vacation pay payable and recording the salaries or wages payable and other deductions or tax-related deductions. Next thing that we want to cover is pensions. And pensions is another important thing that I remember I never paid attention to until I started getting older and I realized that pension is one of those things that you have to pay attention to. So pension is a cash payment to retired employees. Pension rights are accrued by employees as they work, based on the employer's pension plan. There are two basic types of pension plans. One is called the defined contribution plan and the other is called the defined benefit plan. So one is called contribution and the other is benefit. So let's see the difference between these two. And we'll start with the defined contribution plan. So in the defined contribution plan, the company invests contributions on behalf of the employee during the employee's working years. So normally the employee and employer contribute to the plan. One example of these is the 401k, and I think this plan now, or the defined contribution plan, is widely used nowadays among many companies. So the employee's pension depends on the total contribution and the investment returns earned on those contributions. It's actually easier to estimate. It doesn't actually go through difficult estimations like the other defined benefit plan. So as I mentioned before, one of the more popular defined contribution plans is what we call the 401k plan. Under this plan, employees contribute a portion of their gross pay to investment, such as mutual funds. A 401k plan offers employees two advantages. The first advantage is that the employee contribution is deducted before taxes, so you don't pay taxes on it. However, you pay taxes when you make earnings on your investments and you use these investments, or you liquidate the investments. The contributions, the other advantage is that the contributions and related earnings are not taxed until withdrawn at retirement. So in most cases, the employer matches some portion of the employee's contribution. So they say, okay, we'll match $1 for $1 for the first $10,000 you invest in a 401k plan during a year. And anything other than that is your own contribution. and they always have a cap on how much you can contribute to this plan. So the employer's cost is debited to pension expense. So let's see this example. Assume that Haven Scent Perfumes Company contributes 10% of employee monthly salaries to an employee 401k plan. Assuming $500,000 of monthly salaries, the journal entry to record the monthly contribution would be as follows. So we're going to debit pension expense for $50,000, and remember that's 10% of their salaries. And we credit cash because we have to pay the cash up front. That's the only disadvantage from the employer side, is that they have to make the contribution right away. Unlike the benefit plan, they just create an allowance for that, and we'll see how it works. So for the other method, which is the defined benefit plan, in the defined benefit plan, the company pays the employees a fixed annual pension based on a formula. The formula is normally based on some factors such as the employees' years of service, their age, their past salary, and having all these elements together, or variables together, or factors together, you can decide on how much is the pension going to be for that employee. In a defined benefit plan, the employer is obligated to pay for fund the employee's future pension benefits. So they're just funding it, but they're not investing it right away. And that's why we always see that some of these employers, they underfund, and because they really don't have the obligation to pay the pensions right away. So the pension cost of a defined benefit plan is debited to pension expense. Cash is credited for the amount contributed or funded by the employer, and any unfunded amount is credited to unfunded pension liability. We don't see this in the defined contribution plan because there's no way it can be unfunded or underfunded. It has to be funded to exact amount that your employee contributed to the 401k plan. So assume that the defined benefit plan of Henkel Company requires an annual pension cost of $80,000. This annual contribution is based on estimates of Henkel's future pension liabilities. On December 31st, Henkel Company pays $60,000 to the pension fund. The entry to record the payment would be as follows. We're going to debit the pension expense, which is $80,000 based on the required cost here. Since it only paid $60,000, so we're going to credit cash for $60,000, and the difference, $20,000 on the credit side here, we're going to record it as unfunded pension liability. And again, that's permissible under this kind of plan. So if the unfunded pension liability is to be paid within 1 year, it's reported as a current liability on the balance sheet. Any portion of the unfunded pension liability that would be paid beyond 1 year would be classified as a long-term liability. Now let's see some other post-retirement benefits that employers can provide to their employees other than pensions. So employees may earn rights to other post-retirement benefits from their employer. Some benefits include dental care, eye care, medical care, life insurance, tuition assistance, tax services, and even legal services. The estimate of the annual benefits expense is recorded by debiting post-retirement benefits expense. If the benefits are fully funded, cash is credited for the same amount. If the benefits are not fully funded, and typically it's underfunded, a post-retirement benefit plan liability account is also credited. We've never seen any employer would be overfunding. It's always underfunding. So the financial statements should disclose the nature of the post-retirement benefit liabilities. In the footnotes or the disclosures, we usually include some notes to financial statements explaining the situation with these kind of post-retirement benefit liabilities. So let me stop here. In the next video, we'll start talking about installment notes, which is again a continuation of liability.